Hi, I'm Hannah Wallace and welcome to FinextraTV Unplugged. In this interview, we'll be speaking about the impact of COVID-19 on institutional investment, the status of funding for the fintech community and whether investors are becoming more careful with their lending and what the best option is for those looking for investment. To help us through the topic now is Alison Harwood, head of the London branch at Varengold Bank. So, hello Alison, thank you very much for calling in.
Thanks, Hannah.
No problem at all. So before we delve into more detail about those areas I've just listed, it'd be great if you could kick things off and tell us a bit more about the type of companies institutional investors are looking for and really what makes a great relationship. Let's start there.
Yeah, so certainly I can speak from Baringold's perspective. We provide finance to alternative lending companies, usually fintech lending companies. So we're looking for fintech lenders who have a differentiated product offering. Hopefully that is bringing a better service to the customers that they're providing loans to. They might be able to power the credit scoring in a more effective way than the incumbents. They might be able to originate in a more cost-effective way. There are lots of different models that we look at, but we're looking for a differentiated proposition that we believe will be scalable over time. We're also looking for sound credit scoring and underwriting policies and a robust operation and an experienced management team.
All right, so that's interesting. And of course, it's fair to say we've seen some big changes since the pandemic. So I'd like to hear your take on the impact of COVID-19 on institutional investment. And what do you think the future looks like? Because we're starting to look post-pandemic now, aren't we?
Yeah, so I think it's certainly been a really challenging year for institutional investors. There's been a lot of cautiousness. Clearly, this is a kind of event that is very difficult to model defaults. There's been the interaction between what would normally happen in these kind of economic circumstances, plus what is the impact of government support schemes on potential default rates within portfolios. So we've certainly been cautious in continuing to lend. We are continuing to lend, and it's been actually a really interesting and varied opportunity set that we've seen through this time. We've been able to partner with some fintechs on allowing them access to the coronavirus lending schemes, or provided liquidity they can use to lend out to customers under those schemes. We've also obviously been more highly focused on transactions with really robust collateralization to make sure that they can be resilient throughout the years to come.
Mm-hmm. Well, in the past and a lot of the events we were attending before COVID hit, we were talking a lot about the importance of partnerships. So following on from what you've just said, I'd like to hear a bit more about the status of funding for the fintech community. And would you say there's been a slowdown in funding in the sector, and maybe not taking into account what you've just said?
Yeah, I think there has been, certainly on the debt side, I think there definitely has been a slowdown. And I think that's really where the partnership approach comes into its own. We like to see our clients as being partners rather than them just seeing us as another debt provider. And where you have a deep partnership with your clients, then you can work with them to make sure that there's a good outcome for everyone, and you can keep in very close contact about how things are developing through this time. But at the same time, where you don't have an existing relationship, that's where it can be tricky to look into new transactions. And I think it's been a really interesting time on the equity side, because obviously there have been some really chunky valuations over the last few years that have been really stressed throughout this period. So there's been some interesting M&A activity, and I think it's probably a really interesting time on the VC side. We don't get to see quite so much of that. So I think on the debt side, it's definitely a time where established partnerships are really bearing fruits.
And I want to talk a bit more about that in a bit, but before we do, I just want to follow on from what you've picked up on already, because as we've entered uncharted territory recently, do you think institutional investors are more cautious and considered with who they lend to and invest with as a result?
Yes, I think they are. I think this period is a moment of threat for the fintech lending industry, but at the same time a moment of opportunity, because it's a time where the general public are accelerating their acceptance of digitized financial services. So that presents this huge opportunity for the fintech lending industry to step into. But at the same time, they're not in the privileged position that banks are, having low-cost deposit funds to lend out to those customers who are in a time where their own liquidity needs are meaning that they really need to be able to get credit, and they need to get it quickly. They don't want to go into a branch, and they want to do it in quite a seamless way, which is what the fintech lending industry is perfectly positioned to do. So there's that opportunity counterbalanced by the threat for the industry of not being able to secure the liquidity to meet the customer demand.
Sure. No, it's really interesting. It'd be interesting to see how this space develops. And finally then, and just to be clear, at Varengold Bank, you're providing debt financing to alternative lending companies, therefore giving an investment perspective from a debt angle rather than equity. So looking at options for investment then, how do you determine the best fit? For example, debt financing as opposed to equity finance or venture capital. What do you think is the best option? How do you choose?
So from a client perspective, we're working with lending companies, and we look across quite a lot of different segments within the lending vertical. So we're supporting SME lenders, consumer lenders, real estate backed lending, asset backed lending, and invoice receivable lending. And for those kind of companies, they have two different demands on their financing needs. So one demand is financing to grow their portfolios, and that's where we come in and we will provide financing to a ring-fenced SPV structure, and we will allow them to grow their portfolio and take it to the next level with a scalable facility to do so. What we're not doing is providing financing to meet the working capital needs of the business. And that's where they have quite a few different options. Equity can be very expensive, and you certainly don't want to be using equity to grow your loan book. You might need a little bit to support a first loss piece, but otherwise it's a hugely expensive way of funding a loan book. You've also got the VCs out there who will be looking to provide either debt or equity in a number of different ways. So it might be hybrid debt that could convert to equity, all of which I think is quite difficult for a young startup to get a handle on and to choose which is going to be the best for what their immediate need is. If their immediate need is to grow the loan book, then an institutional debt facility is certainly going to be the most cost effective and the most scalable way to do so. But if they need to make tech investments and develop their infrastructure, make new hires, then they're looking at, maybe some family office money, maybe some VC money, potentially some credit fund money, which would also have a crossover onto the loan portfolio scaling side as well. but they don't want to be using that kind of money, which is very expensive, to fund the loan portfolios. So it's a tricky balance for them.
Yeah, and it's a particularly interesting space at the moment, like you say, as a result of COVID and the other areas you've highlighted. So I hope we get to touch on it again further down the line and see how things have changed and moved on. But Alison, thank you so much for getting in touch. I'm glad we had a chance to speak, and it's been a pleasure. Thank you.
Thanks, Hannah. Great to be here with you today. Thanks.